Hello, welcome to the IIS Cyber Panel. My name is David Peace. I'm a member of the IIS Research Board, Advisory Board, specializing in the cyber topic. Today we have a very interesting panel to discuss the cyber risk with Lloyd's of London, with CyberCube, the largest modeling company for cyber, with Chubb Insurance, and moderated by Aon. The cyber risk is increasing still. Just a few days ago, we had the Optus breach in Australia, where many records were stolen, and the risk is increasing by the day. The insurance prices are hardening and increasing. The limits and coverages are declining in some cases. So we have to look how we can address this risk with more commonality and learn lessons from the catastrophe modeling over 25 years ago, where we were faced with similar challenges of historical data and such like. So the panel today is going to address this. They're going to look at the future of modeling. They're going to look at the current situation and the challenges ahead. So I look forward to this panel very much, and I'll now hand over to the moderator. Thank you very much.
Hi, everyone. Thank you for joining this panel on building a common approach to cyber modeling. Currently, approaches to cyber modeling result in extremely divergent results, both in terms of cyber catastrophe models as well as non-cat actuarial analyses on cyber portfolios. This divergence creates challenges in the cyber risk industry around aggregation management, pricing, capacity, and trusting results. The panel will explore these challenges and opine on the best paths forward in building a common approach, and whether the goal is a more unified approach to cyber modeling, meaning that the same portfolio will have similar results from different models, or something else. Experts will dive into top-of-mind issues that are crucial to creating a common approach, and then speak to the challenges and benefits of moving in that direction. We have panelists from different areas in the industry to provide a diverse perspective on these topics, including Neil Arkley, who's head of cyber underwriting, responsible for the oversight of the cyber reinsurance and insurance market within Lloyd's; John Laux, who's the vice president of analytics for CyberCube, the leading cyber risk quantification platform for the reinsurance and insurance industry; and Matt Prevost, who's the cyber and tech E&O product manager for North America at Chubb, and also chair of Chubb's Global Cyber Product Board. Thank you to all of our speakers for joining in this discussion. And with that, let's dive in. First topic is challenges with the divergent approach to modeling as it stands, and what direction are we going to take to fix that? So Matt, let's start with you. What challenges do you have at your organization due to cyber modeling producing divergent results in the industry? And what benefits would a common approach to cyber modeling provide?
A few things. One, the cyber insurance industry is 25 years old. So where that's a positive is some of the divergent results for per risk modeling. What challenges remain ultimately is on the cat modeling side. And there's a fewer areas to focus on. One, we don't have much historical cat event data to lean on. So as we evaluate risk, understanding what historical events have occurred, that's an area in which other lines of business have had benefit of historical cats. In recent years, last 24 months, we've had Valorigate, we've had a few cloud outages, we've had NotPetya, Kaseya, and WannaCry, which we can glean some instance or some understanding of risk, but we haven't necessarily seen exposure represent itself multiple ways, multiple times for historical cat events. Also, unlike NatCat, in theory, we have no geographic bounds. So really the focus is on single points of failure, common software, common hardware, and common service providers that in today's day and age, the dependencies on those service providers is escalating in scale, accumulating single points of failure at scale year over year, faster than the pace that cyber insurance industry grows. And additionally, some of the challenges we do have, inquiries from regulators, government, rating agencies on cat modeling, but also recognition that we're what I would say are positive questions from policyholders, agents, brokers as to, where are our single points of failure, and obviously how and why do we care. So what we're doing, obviously, we're focused on partnering with outside firms, third-party modeling firms, cybersecurity firms, to try to understand these models better, and also modeling for more and more scenarios. So as we've seen historical events, again, the last 18 months kind of represent exposure, we've also had the chance to really dig further into understanding some of the models on a per risk basis. And the positives here is obviously bringing a decision at an individual risk as part of some of our attritional models, and really representing that from an individual transaction, where small business is trying to make decisions on controls, and almost having that same impact all the way up the risk-bearing stack, from primary insurer to reinsurer, to the ILS market, recognizing what's driving at the models. And again, challenging topic, one in which it's going to continue to be more data-driven, but within the primary market, it still is an extremely challenging topic. The positive is we used to have the same conversation around kind of these challenges for per risk models, and really kind of the argument that we don't have historical actuarial data. 25 years in, that's kind of moving into CAT modeling challenges, not the attritional risk model.
Great, thanks, Matt. John or Neil, do you have anything to add? Kind of the conversation around the challenges you face in your business due to the divergent views and benefits to a common approach?
Yeah, maybe, Crystal. I think Matt summed up a number of the challenges, and obviously CyberQ is one of the leading modeling agencies out there specializing in cyber. But I suppose I'd probably step back just a little bit as to why it's important. The key thing is that we've got major challenges in the cyber insurance market, as in it's doubling every 3 years. It's got a tremendous shortage of capital, which needs to come up. It's got a very traditional model at the moment, insurance and reinsurance, and we need to attract alternative capital into the market. And you won't do that unless you've got good modeling. And the kind of stuff that Matt was talking about, or the various variations that you've got there, are really key to get other financial markets to come in and go, we like the divergence, we understand what's going to happen, we understand potentially how much money we can lose, and then there'll be value in them actually coming into the marketplace. And that's one of the key challenges we have at Lloyd's, is we've experienced massive growth, but it's how to keep that growth going in a sustainable manner with a diverse capital portfolio. So I think what stuff Matt and others are doing is really important.
I'll maybe offer a bit of a different perspective on this. I agree with everything Matt and Neil just said. From the modeling company vantage point, at CyberQ, we are fortunate to serve many of the leading participants in the industry. And one of the things that I think is somewhat surprising is just kind of from our vantage point, seeing just different approaches and different competing priorities as you look across how different companies are using even the same model that we provide to them. And I would say it's somewhat company specific, but I think it's more situation specific. There are certain situations that call for really trying to grasp specific tail scenarios, and Lloyd's is probably the emblematic example of that in terms of the RDS framework. So looking at scenarios for managing capital, managing to risk tolerance, really important considerations. And you can do that either, originally deterministically, but of course now, our model and most of the models are stochastically generated. But there's other situations where you really need to look at a full event set and a full loss curve. And, that's really pretty essential when you're thinking about reinsurance, structuring, pricing, setting a catastrophe load that you're going to put on the business overall. You want to know all the things that could happen, which is in some ways a trickier task. And we see different of our customers focus one way or the other, and that can just lead to some very different directions and areas of focus. But I think kind of one caveat that I feel like I have to make as an actuary in the conversation also is, Matt, I agree with you, like the single risk perspective we've kind of generally grappled with, but loss ratios for the industry rose 30 points between 2019 and 2020, at least based on the US data. And I think Lloyd's had something similar. And that was not caused by the tail, right? That was a rise in ransomware as a service. So, we can't call that a 1 in 100. That was maybe at worst a 1 in 20, right? Maybe even more like a 1 in 10 or a 1 in 5. And so I think one of the important aspects to my mind in terms of maturing this conversation is just, we've been using the term cyber in this very broad way to refer to a lot of things. And as we go forward, I think it's important for us to get a little more specific in places like this around when we talk about cyber, what do we mean? And when we're talking about cyber modeling, are we talking about the tail? Are we talking about this year's loss ratio and the volatility around where it might land? And I think the more specific we can be in that conversation and the more focused we can be, the better we're going to be able to kind of focus the conversation around specific areas for improvement.
Yeah, thanks, John. That makes a lot of sense. I think, a lot of the issues kind of tend to be towards the cat side, just because there's, as Matt mentioned, less data around that. But it's definitely interesting to kind of look at both pieces, both attritional and catastrophe. So that's a good point. I'm going to kind of pivot a little bit to something Matt touched on, in that cyber isn't exactly a new line anymore. However, it is still young from the perspective of industry leadership. So it's natural to make comparisons between cyber and other lines, property cat, for example, or specialty casualty lines, and kind of, relating to that per risk issue that's already kind of been fleshed out in the market. So I wonder if these comparisons help or hinder what we're grappling with cyber risk modeling. So John, what are your thoughts, and what kind of lessons can we learn from property and casualty and apply to cyber?
Yeah, thanks, Crystal. I guess to build on my last point, I think the way the term cyber is treated today, it's almost like the analogy I would almost make is if you took property, marine, aviation, auto, and energy, and you lumped it all together into a single line of business called physical insurance and said, hey, industry, go manage that. Like, that's kind of how cyber is being treated today. So I think it's good to reach for analogies that we can grapple with, but there's limitations to that. I think probably the biggest thing that cyber's kind of done the property mindset a favor, in the sense that cyber started as a liability line, but given particularly, I would say, the rise of ransomware, the losses or the exposures from cyber have really become much more short tail. So having kind of a short tail, more property-esque view has made a lot of sense, and with that has come the introduction of catastrophe modeling for cyber and that approach, and that's, I think, been a valuable addition. Back in 2015, the modeling companies were just trying to convince people that this could be a catastrophe exposed line, and I think today, and especially after NotPetya, I think we've seen, okay, that is proven to be the case. I think that the downside maybe of sort of taking a property view is that the property cat models have had 30 years of maturation at this point. And I think people who are steeped in that world are used to a very, very fine level of granularity around the exposures, around the model outputs, things like that. That can actually be a disservice in terms of recognizing both just what kind of data is captured about cyber and also how quickly things evolve. I think on the casualty side, it is worth bearing in mind, again, that cyber is generally managed by the casualty side of an insurance organization, where cat is not usually a concern. So that's been something that I think the industry's had to kind of grapple with and contemplate, because the notion of incorporating, say, a catastrophe load into your business is, not something generally that is done in professional liability, for sake of argument. And so there's some considerations there. But to go back to my loss ratio point from earlier on, I think what you do see a lot in casualty is there's just a recognition that there's an underwriting cycle, that loss ratios do move, both from rate environment changes as well as just underlying, threat environment changes. And those are things that I think we need to contemplate when we're thinking about how cyber can move too. There's a cat component, but there's also just a volatility component, both from the pricing side and the loss trend side. I think the one thing that, whether you're coming from a property or a casualty side, really needs to be recognized as more unique to cyber is the speed at which things can change. P&C insurance is still generally built around an annual policy cycle. And in the cyber threat environment, a year can be a really long time. And so we need to think about the ways that cyber insurance can be more adaptive and responsive to cyber risk as the cyber risk is evolving.
Yeah, I would equate it, kind of some of the learnings from an underwriting perspective from, past events in the property space. Hurricane Andrew, the obvious example, right? It consequence more carefully managed coastal exposure. I think about that from a cyber perspective is really a focus on single points of failure that we have concerns with. Hurricane deductibles being introduced. That's something that in the cyber market today, there's a number of markets that have introduced catastrophe structures, whether that be limit, attachment point, or pricing, that has that analogy directly to property and specifically from models, right? So driving some of those decisions on the primary side. Another consequence from Hurricane Andrew, greater use of reinsurance capital. So again, bringing ILS in or bringing alternative structures in, that's something that's happening in the cyber insurance market today, which is new, right? And again, with the models developing, and again, I'm particularly focused on CAT models, but CAT models developing, that also kind of breeds success in that. And then, most importantly, the evolution of more sophisticated CAT modeling, but also driving more sophisticated risk-specific, what I would refer to as building codes in property, is really an adherence to individual risk controls that show importance as you look at some of the models that are driving concern. So, we do see kind of the cyber evolution leaning more into kind of, I would say, property and property CAT post 1992, and that's really where we think the market is heading. For good reason, right? Is recognizing that these events have occurred. Not petty, as John mentioned, as an example, almost 5 years ago, and it's been, it's ultimately been there. We know it, and we continue to model and kind of model for, those scenarios that are driving concerns. Not that much different from property, right? So as those property CAT models change and evolve over time, so does cyber, and that's actually what we've seen with some of the different cyber models.
Sorry, Chris, I was just going to add to, obviously, what Matt and John have said is absolutely, again, clear. I suppose the challenge, and look, I've been dealing with CAT kind of cyber models for now, 15 years, really, is that the challenges are the ever-evolution, ever-evolving threats, which has been picked up. But you're also trying to model social sciences, not natural sciences. So, with property, and this is the natural correlations to go to property in that CAT, you pretty much know where the CAT's going to happen. With cyber, it's ever evolving, it's ever changing, and that's a problem. The other big challenge we've got is systemic issues, which I know we're going to touch on and certainly we'll discuss. All of this is great, but when we're talking to alternative capital providers, they look at these models and they go, they're very complex compared to Nat CAT models. And I think this is the bigger challenge we've got, coming to the point I made earlier on, is how do we attract capital into the cyber insurance market, because it's really needed. And I think the stuff that Matt and John and others are doing is really important in this space, but we need to be able to properly correlate what's going to happen. And I think the interesting issue was about CATs the losses that we've had, and the cyber market's been challenged, as has been mentioned, and we didn't have a CAT. So again, we need to be able to build models which attract people to this marketplace. And I think we always need to think what the end result will look like. The more and more complex models may not necessarily be the solution, but it's a challenging area. So I know there's no easy answer.
Yeah, and Neil, I would just add, I mean, a common lexicon is really what I think is challenging specific to cyber, right? So there's a varying degree of knowledge, for what are complex exposures that I do think as we kind of work towards consistency is ultimately that common lexicon is going to drive behavior. And really just illustrating what's driving, the risk-bearing concerns in the market, and being able to kind of correlate that back to an insurance transaction. That seems to be what I would say is the way forward, so that there is an understanding all the way up in the IIS kind of decision making, and really just talking the same language. And that goes, I would say, for some government involvement as well, is understanding where the risk tolerance is for the private insurance market, and recognizing there are areas in which, as we model, we are ultimately deeming to be uninsurable or necessary to structure a bit differently. And that seems to be the way forward, is getting some commonality, again, not just with cybersecurity terms, but also kind of across the globe. And that I think is the unicorn version of that's what we need to get towards. And again, progress seems to be there, which is the optimist viewpoint.
Matt, I was going to make a similar point on a common lexicon. So maybe just to add to that, I think it's one of the things that excites me about where the market is at right now. I do think we're in a place where we're either capacity constrained or approaching capacity constrained. But I think this is, a few years back, before the market began to harden, cyber risk really was an all perils product. Everything was covered. And that's sort of where the market was at. We're now in a place where I think the industry is recognizing we need to get more thoughtful about how we deploy capacity and where we deploy capacity. So kind of back to my earlier point, like the big term cyber maybe needs to be, broken out into more specific definitions of events. Chubb has been one of the companies leading the way in that regard in terms of specifying what an event is and sort of explicitly maybe bringing pricing around that kind of a thing. Our model's built around different scenarios. I think this kind of thing is important. And, I agree with Neil's point, looking at additional sources of capital, I think is essential. But I don't think capital is going to take a bet on cyber at large. They're going to take a bet that's more focused around cloud, or even maybe specific kinds of cloud services, or, specific kinds of ways that malware might deploy, across, countries or geographies, things like that. So I think this is a moment, I think, with a lot of potential for creativity around how we advance and innovate in this. So I think from maybe some of the current challenging conditions, there could be a lot of innovation that follows.
Yeah, absolutely. Thank you all for your thoughts around that. And you touched on cyber catastrophe modeling a few times. And I know, Matt, you mentioned kind of finding consistency. So, kind of focusing on the CAT side of things, my personal view is that vendor models are likely going to be our best bet at arriving at a common approach due to their large scope over a number of portfolios, but also the benefit of there being a few models that many companies use rather than, many internal models. So Neil, I'll pivot to you for this one. What do you think is the best path forward for finding a common approach? And then also, what does a common approach mean to you? Does that mean similar results from every model, or does that mean something else?
Okay, that's great. In the short term, I think, and probably this is not what Matt wants to hear, but we've probably got multiple models and looking at it. And when I was at Aviva, we appreciated having different models as well as our own internal view of what the exposures would be. And I think a lot of syndicates do it on that basis. They have multiple points coming in. But we do need to have this common lexicon, this common approach. And the big things that I've been very quite wanted to happen for ages is common ways of collecting data, and also just mapping out claims as well. There's been a number of initiatives to try that. The Geneva Association, of which quite a lot of the larger insurance companies were involved with, tried to do that. It was very complex and it just never got traction. Obviously, you've got bodies, and I'll call them out. I'm certainly on a personal level very supportive of them. Is the guys at Cyber AccuView, who I know a number of the bigger cyber underwriters in the US are members of it. That kind of thing would help a lot if we got common data, and then we could start building on that to get some more commonality in the results. I think one of the reason why I said or standardization in the results, because at the moment, I went to a CAT conference recently, a modeling conference recently, where they were looking at it and they compared the cyber outputs to NatCat outputs. And cyber was literally all over the place. But the NatCat had greatest kind of commonality or correlation between the results that they threw out. I'm not worried about that. You've got to remember that they've got 20 plus years ahead of us, but we need to be going into that direction. And one of the things that the NatCat guys did do was to standardize data collection. And I think that's a good starting point. Let's think of this as a long-term project without any really quick short-term wins.
Yeah, and the common taxonomy of claims data, I think, is the best first start. And Neil, on Cyber Active, again, Chuck's one of the founding members. That the goal is ultimately to get towards commonality for claim data, but also showing and being transparent with what's driving losses. So in a variety of different ways, I know Neil, and even John for that matter, we've been involved in a variety of different undertakings to kind of share claims information that hasn't really gone forward, which historically was a competitive issue in the market. Again, I'm dating back to about 10 years of kind of a hesitancy to share claim data based on that being, the competitive advantage. I think where Cyber Active View kind of brings that forward is you start to get commonality and you start to have a common point, at least from a data taxonomy, be able to share kind of more informed data more broadly, whether that be with government, with policyholders, that isn't biased by any one underwriting company. So again, some of the underwriting that we do with controls, obviously some of the information would be kind of leaning towards, what we didn't underwrite to. So as an example, the whole industry not necessarily underwriting to multi-factor authentication, the claim data historically represents that. As the industry starts to move towards, I would say, an expected control, I stay away from saying minimum, but almost an implied control of multi-factor authentication. Obviously, the claims data evolved to represent underwritten risk versus not underwritten risk. So the industry can show, from a societal perspective, this is the benefit, and that's I'm speaking per risk and some of the per risk understanding. But as that claims taxonomy takes hold, the benefits, the catastrophe modeling, and almost from a catastrophe concept, also start to resonate a bit more. Is kind of seeing the common theme, or at least an event that leads to economic impact. There's other interested parties in some of that analysis, and that's really where I think the starting point is. And obviously, as we model before an event, we start to understand kind of where that claims data taxonomy takes off and kind of takes shape for future kind of analysis. And that's encouraging, based on we've gotten over the competitive hurdle as a marketplace, and that's again the way forward.
Yeah, everything that you guys are mentioning would be great advancements in terms of making this a more tractable task across the board. Just to reflect from my vantage point, I think we certainly, I think transparency is really essential, and you guys have both kind of alluded to that in different ways. Certainly, like for our clients, we want them to understand what goes into our models as much as possible. I think there's a recognition that whereas property cat models, the black box analogy gets made, I think it's clear that cyber's not going to succeed with black box models. We need to be able to let people in and understand our thought process. And our clients have found that really helpful, especially around change management when we make updates. So we've taken clients, point by point, module by module, if that's what they want, through what we've done, which I think is, we want people to get a level of confidence in what we're doing. And I think just to touch on one of the things you said at the start, Crystal, with this question, there's actually a way I think that there was a period in the property cat world where the models were kind of taken as gospel. And, you might blend two of them, but basically the numbers were what the numbers were. And, there's an evolution now toward more of owning your own view of solvency, owning your own view of risk. I feel like in a way what the cyber market is kind of almost of necessity doing is skipping over that middle period. So of course, we certainly want to be one of those models that companies are using, but, we're under no, it wouldn't serve the industry for people just to take, what, CyberCube puts out or another model puts out without questioning it. So what I hope that we can foster in the conversation is a healthier dialogue around this. And so, we may provide a baseline view. I do think the market needs a currency of risk, which of course we aspire to be for facilitating transactions across the curve. But, everyone's going to kind of have their own little adjustments to that based on what they're seeing. And, I think we learn by having conversations and dialogue with the industry and recognizing, the places where people are grappling with different questions or have a different view. So, yeah, I'm excited about that.
Can I just quickly follow up, Christopher, just on that John's point about taking ownership? That's exactly where we've gone with Lloyd's. We had a very prescriptive approach 2 or 3 years ago. We had a thematic produced on CATIT, on modelling. Obviously, it's open that we partner with CyberCube in generating some of the RDSs, but we're now pushing much more to the syndicates having ownership of that and those results, and to actually start validating it. And the reason why that's really important is because at the end of the day, they've got to be the ones who explain to not all the multiple stakeholders they have, reinsurers, rating agencies, regulators, what the results are actually throwing out. So what you just said is really important, is that ownership, and skipping out that middle layer, or that middle period, which the CAT guys went through, would be really good, because I think will really help the market develop.
Yeah, thank you both. I think that's really helpful, and kind of a different view from maybe what I was thinking at the beginning of the panel of a common approach. It's actually, common approach, but kind of with nuances. So I think that's really interesting and a good direction for the industry to go. So thank you for bringing up those points. I'm going to pivot just a little bit and kind of dive into a few specific topics now that we've kind of set the stage on the challenges, we have at this common approach, and benefits to moving to the more common approach. So one thing that I think we kind of struggle to align on in the industry is how reactive to be to the cyber catastrophe events that we're seeing unfold. So we've seen CAT events happen in recent years that have not resulted in losses as high as predicted in the cyber CAT models. So can you speak to how reactive the industry should be to this outcome? And Neil, let's start with you on this one.
Okay. Probably the least expert of this panel for that, but the biggest loss that everyone always refers back to is not Petya, and I think what we may come to the conclusion, and there was about 4 events last year, SolarWinds and others, which came through the market and actually just created a ripple. There was certainly increase in number of breaches that had happened. I think in fact, we were just doing yesterday, we were talking about extreme CAT events at Lloyd's, and I think it's probably going to be multiple events happening. Without going into too much detail with our own internal thoughts, but it could be that a number of things have to go wrong for us to have a true CAT event. So NotPetya was not only a version of malware which could cause problems, it was actually almost designed as wiperware, really, wasn't it? But it also had a nation state backing it as well, with a motivation to cause problems. And I think, obviously, unfortunately, history has shown what their long-term plan was. So I think that's probably where we're going to go. I think we're going to have a market which has a lot of attritional, and we'll run a combined ratio. I mean, Swiss Re threw out a number recently. And then we need to build in some pricing for the big CAT events that's going to happen. And it will probably be multi-factor. That's kind of where I'm coming from at the moment, but I will more than bow to those on the panel who deal with this every day.
So yeah, I can speak to how we're approaching this, and the point's valid. I mean, I think from before I left reinsurance broking, I think we were seeing like one and a half loss ratio points from Kaseya, Microsoft Exchange, the events of last year, which is certainly not what the models are generally saying. At CyberCube, we've implemented a process of like regularly looking at the real world events that are happening and evaluating them both for, I guess, how well they fit with the catalog we have, as well as what lessons we can learn from that. And that's been a really interesting exercise to go through. Generally, we feel quite good about our catalog based on what we're seeing from that research. I think it points to the fact that there's a really wide array of things that can happen. And so the tendency to just sort of drill into like one or two specific scenarios, I think, can miss the mark. But then I think that the really interesting work comes when you kind of start to pick apart what can we learn from the specifics of those events. And so, when an event happens, let's just take SolarWinds, for example, which didn't end up being a big loss to the industry, but could have been. We can look at what was targeted. In that case, it was a software supply chain exploit, which had significant aggregation potential. We can look at the threat actors' motivations, as Neil just mentioned, and that was, I think, one of the big things, which was the motivation of that attack seemed to be more espionage focused rather than destruction focused. Had that flipped, that could have been really, really bad. We can look at the tactics, techniques, and procedures used. And then finally, I think we come to the losses. And of course, the losses there were not significant. But I think what I'm learning as we go through this process is that in many ways, the difference between a really bad CAT event and a fairly inconsequential one may not be just a difference of degree, like how long things were affected, but more of a difference in kind or in quality, in this case, specifically the motivation. And so, I think in my mind, I think the lesson that folks like us need to learn is that the tail is the tail, but for scenarios that we assign higher probabilities, we do need to consider these real world events and kind of think through what the loss potential is based on what we're seeing. And that gives us ways to both validate how we're thinking about the tail while calibrating, kind of lower down the curve for the events that are going to more drive, this year's loss ratio.
Yeah, again, across the industry, we cannot kind of approach the near miss as no problem, right? It's not the way the industry is thinking, which is good news. And kind of more action is necessary by separating and defining these losses, right? So some of these events, some of the traits of these events, whether it be actor, the asset that was attacked, or ultimately the way in which it occurred, that's where we're focused. That's how we think there is at least a common framework to think about that and define it and make it part of the primary. So again, we, from a reaction to these past, 18 months, inclusive of the variety of different things we learned from NotPetya, is there has to be a way from a definition standpoint, and one, to model, two, for coverage to align to the model, and then three, just get that common lexicon across the risk-bearing landscape, and ultimately educating society. So again, as the cyber insurance industry has evolved, right? So, recognizing the ransomware of 18, 19, 20, 21, and from an underwriting needs standpoint, that's no different. And that I do think the industry has recognized is we do have to price, kind of cater coverage, but also educate society on what's driving our concerns. Again, using some of these models is helpful not just for insurers, but also for the various risk stakeholders, government, all the way down to the consumer. Right? We're say industry-wise has been somewhat slow to that realization, but I think we're at least there of recognizing the significance or importance of defining these events as part of the primary policy, and kind of catering that into how we look at.
That's something I also wanted to touch on. So that kind of leads into my next question around cyber coverages and kind of similar definitions. So I think we do struggle to align on coverages in the cyber risk industry. In my line of work, I see clients with a wide variety of tailored coverages broken up by loss component, also by type of attack. And then the definitions for coverage also vary from model to model. So Matt, do you think it makes sense for coverage terms to be more standardized to kind of aid in that cyber modeling as well as coverage interpretation? Or do you think it's more important for the coverages to be adaptable to specific business needs?
So there's a few things I think ongoing that kind of lean towards more consistency for catastrophe prone exposures. As an example, Cyber AccuView working with commonality across carriers for catastrophe concepts. So infrastructure exclusions, as an example. I know the LMA has also opined on other exclusions for consistency. That's, I think, where the industry aligning for catastrophe exposed coverage that exists. That's a good thing. And it also kind of leads to more, I would say, inconsistency or possible nuance as the attritional losses continue. So again, if there is coverage differences or changes that occur, that is where there probably is a less need for consistency on the attritional if we can get catastrophe right. And that's kind of where we see things heading. And that's good for policyholders. It's good for agents and brokers to understand where the attritional coverage continues to evolve, which it has evolved every year in cyber since the inception. But if we get attritional coverage concepts wrong in the event of a CAT event, then obviously we're in a bad situation. So that's I think where things are, and with some of the different associations, again, Cyber AccuView and others. Here's the good news: is we're talking about coverage in the context of catastrophe, not for competitive advantage, but for kind of resiliency of the industry, and that's a good thing.
Yeah, those are great points, Matt. I would just add, I think from the modeling company perspective, there's kind of an 80-20 rule to follow, or maybe more like a 90-10 rule, in the sense that we try to create as much flexibility as possible in terms of how people use the models, but there's a limit. And if you wanted to be able to encompass everything, we would need a data schema that would be like far more complicated than most people would want. So there's a balance to strike there. I think what we've tried to do is really do that in partnership with the industry, so that we're giving people what they want and we can be responsive to changes. And that's also one of the reasons I think it's important that we aim to update our models every year so that we can stay up to date with the changes that are evolving.
Yeah, absolutely key. At Lloyd's, we've got two things. One is a resilient market, which is also it is competitive. We want both, and we've got oversight on that. And I think what Matt said about removing or having a common lexicon on the CAT and big systemic problems is really important, and that will obviously help the modeling companies then to work out what the CAT exposures are and all those good things that you guys do with 1 in 200 years, etc. But we want to, on the lower end, the attritional and large losses, then we want a competitive market which gives and tailors the coverage to the customer's needs. So I think it's getting that balance right. I think the market made leaps and bounds. I've been underwriting cyber for about 20 years now, and the coverage there's much more commonality now in the coverage. So that's good. And I think we're starting to get commonality on those big major systemic exposures, and that will be even better, because it will again mean we can move on to the next kind of inflection of this market, and to actually start growing and actually responding to the demand that's still there, and it will continue to grow.
Yeah, so thank you all for your responses to that, and kind of just pivoting the conversation a little bit to the implementation of some of the things that we talked about. So kind of implementing this more common approach. And I know a couple of you touched on this earlier. Creating a common approach to cyber modeling requires the sharing of data and ideas. And that includes sharing between companies that are competing for business. So how do you suggest that we as an industry handle that challenge, and what are the benefits to more transparency? And Matt, I'll start with you, because I think you mentioned that earlier.
Like John and Neil, and I think Crystal, you as well, there's been a variety of different ways or meetings and discussions that we've had to share more data. And this, me personally, this goes back to meeting with Department of Homeland Security 10 years ago and talking about a common framework for cyber incident and data reporting, of which led to meeting upon meeting of different perspectives on how to bucket certain data points, inclusive of hours upon hours of discussing a single data point. And so what realization sets in is as we work together, right, of realizing that the discussions around different data points is where everyone learns, and inclusive of participants that are outside of our industry, I think is the most beneficial. So again, whether that be via the model or whether that be via just conversation, where I see the most valuable benefit is us disagreeing on certain topics that are so granular that both sides start to understand kind of the nuance associated with some of the data that we're trying to model for. Just some examples. Educating a policyholder on what a software supply chain exploit is actually a conversation that when it's happening in the primary transaction, that's good, although most agents and brokers would prefer that not to happen, right? So that kind of slows things down. But as the insurance buyer starts to recognize there are things that the insurance industry can educate on, that's what insurance has done for 300 years. And so that kind of data sharing and the transparency around what we're concerned with, again, whether that be Chubb, whether that be the industry, whether that be, a modeling firm, that's really what we have to remember is the key to successful insurance, is educating and also kind of alerting on various things that could cause loss. And all that is transparency. All that is basically saying, look, here is what's driving our concern, whether that be the model, whether that be a per risk model, and that's just underwriting. Now, take that up a few notches into the different underwriters and the different carriers that have formed some of these associations for educating policyholders, and that's just scale. And that scale, whether it be U.S. or whether it be Canada, whether it be a different country, that's important so that different regulators, different governments start to look at the cyber insurance industry more positively. And that's what we're seeking to achieve is kind of educating on risk, where other industries haven't necessarily done a great job, specifically technology and maybe at times cybersecurity. And that's what underwriters do.
Yeah, those are all great points. I would just add, I think, to underscore the importance of things like Cyber AccuView to bring companies together, Lloyd's as well, just by its nature as a marketplace, I think serves a similar role. One of the things we're doing at CyberCube is we bring a technical user group of our clients together several times a year to discuss important matters in terms of the models and the market and what the market needs are. And we've found that to be extremely valuable to us, and I hope to our participants, in terms of making sure that whatever we're doing from a model enhancement perspective is really done in partnership with the industry, so that things are not being done in a vacuum and we're all moving forward together.
Absolutely, John. It's communication, but also taking into account, antitrust and competition law. So, well, under European legislation and other legislation that's out there, you have an exemption for insurance companies coming together because at the end of the day, we're a pooling mechanism. So there needs to be some commonality there. And you're absolutely right. We need to keep that dialogue going, see what's going on, and adapt. Models like yourselves, I know you guys spend a fortune in making sure it's adapting and seeing new exposures that are out there. But that needs to continue to happen. And I think that the more we do that, the better the market will be. And the other good thing is cyber will then start being seen as a product people want and can trust in and know that it's got a long-term solution for their needs. So I think we're going down the right path in so many ways, but we can all do better. And I think, certainly at Lloyd's, we're trying to get our syndicates to talk much more, whilst respecting the fact that at the end of the day, you've got competitors there who obviously want to do well. And so we understand that, but there needs to be some element of that commonality going forward.
Yeah, thank you all for those thoughts. And I think, one thing we kind of mentioned during that was different organizations that can help to educate the market and bring together these common approaches. So I think it's really interesting to kind of, bring the industry together. And it seems like it's not one organization really driving this, but a number of different kind of organizations within the industry working together. So I think maybe we circle back to the main theme of the conference, which is the Great Reset. So we've heard other panelists discuss questions such as whether the insurance industry is remaining relevant or losing ground. Notably, Aon CEO Greg Case recently noted that the industry is becoming less relevant compared to customer needs. So as we mentioned, cyber insurance seems like a clear case where the insurance industry is sought to help emerging areas of risk. And so as we reflect on the themes of the conference overall, and let's assume we collectively find these paths forward to advance our understanding of cyber risk modeling, what possible opportunities do you see ahead for our industry, assuming we get this right? And John, let's start with you.
Yeah, sure. A couple things come to mind, I think. First, which we've alluded to, is just to know to what extent we're actually succeeding as an industry, which I think is important. I think it's commonly portrayed that cyber risk sort of feels like this constant uphill battle. And there's certainly some truth to that. There's statistics that cybercrime is more than $1 trillion a year global problem. But those are all based on like really broad estimates. It's not like specific measurable data. And so, I think there's an opportunity for here as we share more data and we have a more common understanding that we're building to really define success. And to my mind, success is not just, the insurance market being profitable. Of course, we hope for that, but also that we can demonstrate things like Matt was talking about with policyholders, that we're clearly finding ways to reduce risk and track that over time. So I think that would be extremely valuable from some of the things that we're talking about. Another thing would be just much more efficient deployment of capital. As I said earlier, there's one thing called cyber right now. If we can get more specific about that and kind of bring that capital down to target specific kinds of perils, specific kinds of exposures, I think we're all going to be able to get more creative and maybe attract in some of the alternative capital that we'd like to see. I think this is one of the important ways that as the models mature, hopefully the market also matures along with it. And I guess the last thing that comes to mind is just, if we get to the point where, again, there's not like a consensus view, but there's sort of a common framework and then people can deviate from it. What new kinds of products could we innovate around? We talked about the 12-month policy cycle. Like, vehicle telematics are used to give drivers, discounts for safe driving in the auto world. Could something similar be done in cyber? Could you actually get to something more like a shorter duration policy or like a hygiene sensitive policy, where maybe the price adjusts based on, what kind of metrics we're seeing an organization work. And then insurers could really step into that role of kind of coaching organizations as they're doing now, but even more so toward like taking good measures to just reduce risk for everybody. So I think there's a lot of potential ahead.
Yeah, John, I love your comment earlier on of just lumping everything together and calling it physical risk. You're right. Cyber has just evolved, and I think due to the competitive nature where everyone's trying to be all things to all people, it became too broad a product, and it's not really tailored enough to what our clients really want. And you're absolutely right. We can produce much better products and probably bigger limits and more tailored wordings, which would be great. But I think the other thing that springs to mind for me is the wider social purpose of insurance that we've always had, where we help people to manage their risks, but also be there for them when things go wrong. So we can tell them what good looks like, but we're here for when things fail and actually responding to it and getting people back onto the ground. So I think cyber has a tremendous role to play in that. And the limit, the low penetration rates, especially as you go down to smaller corporations, is something that we've got nothing but potential. So we've got great. We need to make a profit. At the end of the day, we need to get a return on our capital, but we've also got a wider social role, and I think that will help people manage their cyber exposures because they're not really understanding them and they're causing them real pain. So I think these are things that we can do going forward. And I think I look at the cyber insurance industry with, I think, great potential, and we've got a number of challenges, talents, pricing, modeling, etc. But there's a lot that we can go and make our industry relevant, because there's no doubt dealing with intangibles is going to be the big thing going forward. It's no longer just providing a tangible product or product for tangible property. It's that how we handle the intangible. And I think cyber and intellectual property and other lines can actually do that.
Yeah, thank you. Thank you for your thoughts. Matt, is there anything you'd like to add kind of on the benefits this common approach could provide to either your organization or the industry as a whole?
Yeah, look, keep in mind these products establish resiliency in the event of a cat. So we actually bring risk down if and when it presents itself to us. And that's really important. So, the preparation of different carriers with recognition of some of the modeling firms' outputs also kind of caters into claims capabilities in the event of a catastrophe event. And that's really important, again, to Neil's point, from a social or society perspective, that we are here and do respond in the event of a large incident. And that's also helping and almost motivating more focus on understanding the models, is understanding kind of the polar elasticity of some of the claims teams that would come into play. And that's a benefit. And that actually establishes resiliency post-incident across the market.
Absolutely. Yeah, thank you. That makes a ton of sense. And thank you for all of the panelists for engaging in this discussion and for everyone listening in on the panel. I think discussions like these are really a great first step to arriving at a common approach to cyber modeling and to figuring out what that common approach really means. So as we mentioned, kind of not one view, but a common framework with multiple views. And as mentioned by the panelists, there are a number of benefits to working towards this as an industry, and we have our work cut out for us given the challenges that we outlined as well. So I'm excited to see industry leaders come together to tackle this and what it'll mean for the cyber insurance and reinsurance market. So thanks again to all the panelists for participating.
Thank you, Crystal.
Thanks, Crystal.
Thanks, Crystal.
Okay, well, that was a wonderful panel and a lot of insights to take away there. One of the issues that I think was covered very succinctly there was the need for a common lexicon and syntax across the cyber modeling world, so that we can blend different cyber models together and look at how we get commonality across the risk, so that we can really address the risk and the risks, individual perils in cyber, rather than just look at an all perils approach and chasing some of the trends that's been done in the past. So I really concur that is a great takeaway from this. What I'd like to add to that is the potential of systemic risk, which was mentioned, that especially during the pandemic, a lot of critical infrastructure was actually digitized even more, therefore opening systemic risk. So there is a real need to address that, and probably the use of captives with a hardening market, with the prices increasing. Looking at a captive market would be a very good idea here. So I think to add to that discussion, that on top of the modeling, we'll be able to add a lot more captive and different retentions to the cyber risk. I think finally, taking the parallel onto the ILS and the cap market, insurance-linked securities, cyber risk with the proper data set wrapped around the risks, we can do parametric insurance with cyber, and we can move the cyber into the ILS space and get a lot more higher coverage, especially for critical infrastructure, and much better limits. So let's take a leaf out of the experts' book there on this panel and try to get commonality for cyber across the industry. Thank you very much.